Hi everyone. Thought I would put together an example illustrating the impact of debt on firms' financials. So here we have an example of a company that at the beginning has no debt, and we're going to see the impact if we go to either 30% debt or 60% debt. As a reminder, we could illustrate the influence of the magnification of debt on your financials by looking at the return on equity as a function of profit margin, asset turnover, and leverage. Most of the time we talk about the influence of profit margin, net income over sales revenue, or the influence of volume, which is using an existing set of assets to try to optimize or maximize sales. Whereas this presentation is going to illustrate the influence of leverage, which is the degree to which we use equity to finance our assets. So the more leverage we have, the less equity we have, and so that will magnify this third term. And so if this third term is magnified, return on equity will be magnified as well. So let's take a look at the examples. Also, let's just mention that the company has, at least at start, 1,000 in assets, an interest rate of 8% if they choose to borrow, taxes of 35%, although I think we're going to avoid taxes for this example, and a stock price of $10. So in the first scenario we have no debt. So you can see that, and we're going to start with three potential scenarios. Either things don't go so well, recession, things go okay, or things go really well. And so in that instance, notice in this case we have no debt, therefore there's no interest expense. And so taking the recession as an example, EBIT of 60, no interest. Take out taxes at 35%, and we get our profit after tax of 39. The first instance of no debt, remember we have 1,000 in assets, and if we have no debt, we also have 1,000 in equity. And if we have 100, or if we have a stock price of $10, then that means that we have 100 shares outstanding. So equity of 1,000 divided by a stock price of 10 leads us to shares outstanding of 100. So my earnings per share, if next year is a recession, I earn 39, 100 shares outstanding, my earnings per share is going to be 39 cents. Similarly, if things go okay next year, thinking about the moderate state, my earnings per share will be about 56. If things go pretty well next year, earnings per share is 260. So we can see under the instance of no debt, earnings per share will range between 39 cents a share up to 260. And if we just applied some throw a dart probabilities, our middle of the road expected earnings per share is $1.52. So on this slide right here, let's kind of keep track of what we found. So under the scenario of no debt, EPS can range from, again, 39 to 260. With an expected earnings per share of $1.52. Fair enough. And what we're going to do is we're going to illustrate the influence of debt on that particular set of numbers. So we have to next understand what happens if we move to 30% debt. So at 30% debt, before we had 1,000 in assets and 1,000 in equity. There's no debt. So in this case, we have some debt that are divided up. 1,000 in assets is now going to be divided into 700 equity and 300 debt. So how does this happen? What process do we use to go and swap from an all-equity company to a company financed at a 70-30 mix? The steps are borrow 100, 2, buy back share of stock with that money. So we know that if we borrow 300, we're going to have an interest expense at an interest rate of 8%. On borrowings of 300, it translates to an interest expense of 24. In terms of number of stock outstanding, we see that previously we had 100 shares of stock, and we bought back $300 worth. We borrowed 300, stock price of 10, we bought back 30 shares. Previously we had 100, so now only 70 remain. So now you can see the influence of debt on our financial statements. Notice these figures are the same. In a recession, we're still going to have 60 of EBIT, but now we have interest expense to deal with of 24. So it depresses our profit both before tax and after tax. So our net income has gone down in all three scenarios, but at the same time, we have fewer shares of stock to share the net income. So the pie has gotten smaller, but so has the number of slices. So when you divide our profit after tax by the number of shares outstanding, our EPS range goes from 33 cents to 3.49. And then if we apply those probabilities, we get an expected earnings per share of $1.95. When I say apply the probabilities, it just means 33 cents one times a 40% probability, 3.49 times 30% probability, up with our middle of the road estimate. So with 30% debt, if we choose to finance with some debt, our EPS range will go from a low of 33 to a high of 3.49 with an expected EPS of $1.95. So let's fill in our sort of mini worksheet from a couple of slides ago. 33, 3.49, 1.95. see now with 30% debt, the low end gets a little worse compared with the no debt scenario. The high end gets better, and the expected earnings per share actually improves. So debt magnifies the range of our possible future results, but also increases the expected earnings per share. Let's take a look at the 60% debt option. This would be considered a fair amount of debt. So for our 60% debt option, so now we've got 1,000 in assets, financed with 400 of equity. Now we bought back shares, so only 40 with the debt that we borrowed, so only 40 remains. But because we have 600 in debt, we have a significantly sizable, more sizable interest expense. So now, given our EBIT, which is the same as in the previous scenarios, earnings are depressed even more because of the existence of the interest expense. So our net income declines fairly significantly, but we only have 40 shares now to spread that around. So the earnings per share ranges from 20 cents to 5.72. If we apply our probabilities in this case, it's expected EPS of 3.02. So the range goes from 20 cents to 5.72. The middle estimate, 3.02. So if we fill in the rest of our little worksheet here, we can see now that the more debt we have, the worse the outcome will be in the event of a recession. Over here on the left is if a recession occurs. So not surprisingly, something that we can review mechanically is something that you probably already know intuitively, which is in a recession, if you have debt, it's going to create a problem. And however, at the same time, in an expansion, the existence of debt will help your company. Think of debt as creating a different set of sort of break even. Once you're beyond that, everything belongs to fewer and fewer shareholders. So they're sharing in the success of the company in an expansion. So the earnings per share doubles in this particular case in an expansion, and the expected earnings per share goes up. The one thing that's not sort of in this worksheet is the risk of the company. So the expected return has improved in the event of more debt, but the risk has gone up as well. And so that will magnify your potential return as well as your risk. So that's a short presentation as to the influence of debt on your potential future results. Not knowing where the economy will be, that we can only say that the existence of debt will magnify both the risk and the potential for return.